Welcome to the Prudent Pulse. Now, today the IMF said that the war is dimming the outlook for many economies. Goldman Sachs raised its 12-month U.S. recession odds to 30%, while consulting firm EY Parthenon raised its recession odds from 35% before the attack in Iran to 40% currently. For now, though, most economists seem more focused on cutting growth prospects than they are on an imminent recession. And while growth prospects are waning, the biggest ever oil production disruption has also ignited a supply shock that has caused 1-year and 2-year inflation expectations to spike, but long-term inflation expectations remain anchored. So what's going on here? A quick resolution in the Middle East currently seems very unlikely, and yet the stock market sell-off has been relatively orderly. Long-term inflation expectations have hardly moved, and a recession, in the eyes of most economists, is still not the base case. Well, one reason is that the US is far less exposed to Middle East oil than in the 1970s or even recent decades. The shale revolution changed everything. US oil production has surged from about 5 million barrels per day in 2008 to roughly 13.5 million today, transforming the country from oil import dependent to an energy powerhouse. Most US oil consumption is now met domestically or sourced from Canada. At the same time, the US economy is now 75 to 80% services based. That's made it less energy intensive than in the past when heavy manufacturing played a larger role. For now, markets appear to view the conflict as a temporary energy shock, not as a structural shift. And importantly, weaker growth expectations may offset some of that inflation pressure. That likely explains the sharp shift in rate expectations following comments today from Fed Chair Jerome Powell. Just a week ago, markets were pricing in roughly even odds of a rate hike by year end. After his comments today, those expectations have shifted to no hikes, as well as no cuts. In short, investors are concerned, but not yet panicking. That could, of course, change if the conflict escalates significantly and oil prices surge even higher and stay elevated. It could also shift if inflation spreads into services, begins to alter consumer behavior, or if the Fed loses credibility in managing inflation. At that point, what is currently a severe but manageable shock could become something far more unstable. And that's the Prudent Pulse.